Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we're going to start talking about the S&P 500, which is on a tear. And you saw the tweet from Donald Trump today saying, stock markets are rallying. Thank you, Mr. President. Always good to take ownership for what has been happening that is entirely beyond his control, I would hazard.
Yeah, of course. But he loves to pat himself on the back, and he does love to measure himself by the performance of the stock market, which, rightly or wrongly, has been fairly good over the last while. Certainly the time that he's been in office, it's higher. So, rightly or wrongly, he's going to take the credit, right? But if we look at the S&P 500, as we always do at the start of the show, and where we're at right now, we're basically bumping up against those prior highs that we saw at the end of April, which is at around about 2950. And I've mentioned a number of times how we had this failed head and shoulders pattern when it broke down below the neckline at 2800. When you get a failed head and shoulders pattern like that, it's invariably it's interpreted as bullish, actually, and you would then expect it to go and retest the prior top and quite possibly even go and make a new high. Now, let's just look at it from a slightly longer term perspective and see where we are from looking at it sort of over a 1 year view, if you will. Here you can see the significance of this 2950 level on the S&P 500. Notice how it was the peak that we saw in September last year. We again saw that as the peak in April this year, and now we're retesting it once again now in June. So it's effectively the third time we are challenging that 2950 area. My sense is that it probably will eventually break through that 2950 and go on to make new highs, I think. The fact that it's tested it a number of times indicates that. It may consolidate a little bit now in the near term, quite possible, because it is a bit overbought and it's had quite a run since the beginning of June. But if it consolidates a little bit here around about this area, potentially that might actually set the stage for a push out to new highs. Of course, the big things that we're going to be watching this week is the G20 summit and the discussion that is scheduled to happen between Donald Trump and Xi Jinping, and whether they can come to some sort of agreement at all or give us any friendly advice in terms of trade negotiations. I don't think too many people are hanging their hat on that being the case, but nevertheless, that's going to be in focus. And of course, the other thing now is the fact that the US Fed has started to indicate that they're turning dovish, and we're likely to get a rate cut in July. And that could actually propel the market through this resistance level, I think, as a near-term bullish catalyst. Longer term, I remain a little bit wary, but as a near-term catalyst, I think a rate cut might be what it takes to push this market through to new highs.
Yeah. You've got a chart of the US dollar index, which you also want to bring up. Why to you is that significant?
Yeah, it's interesting now, and the reason I bring it up now is, again, what I was talking about in terms of the US rates. Now, the US dollar has been the currency of choice to own from a developed market currency perspective over the last year or two. You can see how since early 2018, this US dollar index has gradually been climbing. And for a long time, what I had been seeing is this ascending triangle pattern, which was forming over here. And it then began to break to the upper end of that ascending triangle pattern in April and May. And ordinarily, one would have thought, well, that is the bullish break through the top of the ascending triangle. That's going to send the US dollar even higher. Now, it appears that that was actually a false break. And you can see what's happened is that that break through the top of the triangle pattern didn't follow through. It subsequently turned quite sharply lower. And in fact, it's now broken out the bottom end of that triangle structure. Now, from a technical perspective, this is quite textbook in terms of a false break. And I've seen this happen a number of times where you get a breakout that you would ordinarily think is bullish and should follow on to new highs. And it actually fails, and then it results in a fairly swift move in the opposite direction, which is exactly what's happened. And it means that this US dollar index now has actually broken out the bottom of that triangle structure and could quite possibly be headed lower. The catalyst for this has been the dovish talk from the Fed.
In other words, you're not going to, so people will be less likely to hold dollars because you're not going to get much appreciation or much yield, really.
Well, this is it. So you've been getting, your Fed funds rate has been 2.5% on US dollar deposits, which is a whole lot better than you're getting on euros, a whole lot better than you're getting on yen, a whole lot better than you're getting on pound sterling, right? So the US dollar has been the currency of choice from a yield perspective. Now, if they're starting to talk rate cuts, that starts to diminish the attractiveness of the US dollar from a yield perspective. And that's why you're starting to see the US dollar weaken, I believe. And it's important to note this because it has a whole bunch of ramifications for various different financial markets, one of which is of course the gold price, and we will talk about that at the end of the show as well, because gold has been on a tear in combination with a weakening dollar.
Yeah, okay, we will get to that, but before we do, I know you want to have a look at the top 40 very quickly, which is also bumping up against, I guess, our prior highs of the year.
Yeah, it is. So basically we're bumping up against this 53,200 area, which was the high set in April. You can see quite a few long tails to the upside on the recent daily candlestick patterns there. There's also a little bit of negative divergence becoming evident on the stochastic oscillator there. And what that really means is that the upward momentum is beginning to slow. So it suggests to me that there's a possibility we might see a bit of consolidation here in the near term. I'm probably sitting on the fence right now, and I can't say I'd be rushing out and buying this market, but I don't know that I'd be aggressively shorting it either. And do also keep in mind that these middle months of the year often are quite choppy and quite messy. So I think it's just caution from that perspective.
Yeah. Messy and somewhat disappointing so far, I have to say, if you look at what's happened to some of the locally exposed shares.
For sure. Yeah, it's been a difficult year for SA Inc. so far.
Yeah. Okay, Garth, but we are not fishing in local waters this week for a change. Yeah. You're dipping your toe offshore and looking at Amazon. Why?
Yes, so last week we discussed this chart on the show, and I said that I would be looking at it as a possible opportunity to go long for our offshore portfolio, which has been very neglected this year. What I identified last week was the fact that the stock had been forming this little pennant pattern, or it's like a small triangular type of pattern, and it was above the 50-day moving average, which is that blue line over there. And that ordinarily is bullish, and I was expecting it to break to the upper end and quite possibly go on and re-challenge those prior highs that we saw at the beginning of May. And if that was the case, then I would look to buy. So I've followed through, and I've actually done that for the portfolio this week.
Okay.
I went long at $1,889 per share. I'm going to use a stop loss below 1855, which effectively would mean that whole pattern would now need to fail, and it would have to break out the bottom of the triangle.
So it gives you a bit of leeway.
Yeah, so it gives me some leeway, and so far it's so good. It looks like we're on the right side of that. And the target here is going to be that prior top that we saw in the beginning of May, which comes in at $1,960 per share. So
take us through the mechanics, because those numbers are quite steamy.
Yeah, they are in terms of the share price. Yeah. So yeah, we're going long at 1889 per share. Stop loss is 1,855. It means we're risking $34 per share in this case. I'm going to risk 1.5% of our offshore portfolio. Now we've got $15,000 in that offshore portfolio, so 1.5% of that is $225. That's what I'd be willing to lose if I'm wrong on this trade. So taking it through the calculation that we always do to work out our position size, you take the $225 and you divide that by $34 per share, which is our risk per share. It gives me a number of 6.61 shares. So we can't obviously trade in a fraction of a share like that. So I've rounded it up to seven shares or 7 CFDs. Okay. I mean, it seems like nothing to go out and buy 7 CFDs. But just keep in mind that at a price of $1,889, you're talking about approximately 190,000 Rand worth of exposure. Yeah. So, it may only be 7 CFDs, but in real terms, it's still a chunky exposure. The target that I said is $1,960, and that means, therefore, that my risk to reward ratio on this trade is essentially 1 to 2, which is satisfactory for us.
And easy enough to get those Amazon shares, Garth. I mean, if you've got an offshore brokerage or access to offshore.
Correct. You need to have access to an offshore market, which is very easy to get access to these days. A number of brokers out there in South Africa have platforms that enable you to send your money offshore and have exposure to the whole world. It's not so difficult to open an offshore account these days, and people, I think, often misunderstand how easy it is actually to get that exposure. And remember, you get a 1 million Rand per year discretionary allowance to send money offshore. So you can send some of your money offshore through an offshore platform, and you have the world at your fingertips in terms of products available to trade.
Yeah, so it makes a lot more sense than just looking local.
Correct.
Okay, so that's this week's trade. I know you also want to talk about the gold price, and I mean, this is interesting because a couple of weeks ago you shorted a gold share in the understanding, I guess, that it had run ahead of itself, and that being Goldfields. But the gold price and the gold shares have just continued to mark higher.
They have, yeah. So that's right. And we got that trade wrong and we were stopped out on it. I want to say thankfully, because they have gone higher. So we lost a little bit of money, but not significant money. But yeah, the gold price is what we're looking at here. And I think no technical analysis show or no trading show this week would be complete without a look at the gold price, because what it's been doing over the last week or two is very, very important and very notable. So this is a weekly chart that looks back over the last 6 or 7 years now. And you can see how the gold price has formed this huge big basing pattern over the last number of years, since 2013. And it's bumped up against this line of resistance numerous times over that 6-year period. The $1,350 an ounce level has been significant resistance, and the price has now actually managed to punch through there. When I checked my phone a moment ago before we started recording, the gold price is sitting right now at $1,429 an ounce. So it's made a very, very meaningful breakout through that resistance. It's very significant. And on a medium-term basis, that probably does now open the way for further gains in the gold price. Right now, it's a little bit stretched. You may find it comes back and consolidates and perhaps retests that breakout at some point. But I think if it comes back and retests the 1350 area and holds, that would probably be your opportunity to buy for further upside over the medium term. And this also goes hand in hand with what I was saying earlier about the weaker US dollar. A weak US dollar typically translates into a firmer gold price, and that's exactly what we're seeing here.
Also firmer alternative currencies, which I wonder if it's one of the reasons also why Bitcoin, for example, is at 15-month highs, breaking above $11,000.
Yeah, it's possible. I've seen some commentary on that Bitcoin is also now being seen as a sort of an alternative haven to US dollar, I suppose. It's difficult to kind of try and correlate the relationship there. But I think just in terms of going just back to gold for a second, I mean, what you've also got to remember, in addition to the weaker US dollar that we spoke about, remember gold is effectively an asset that yields nothing. So when you buy gold, there's an opportunity cost of holding it.
Yeah.
And effectively your opportunity cost until now has been that 2.5% that you could earn on your US dollars.
Yes.
If that rate is going to come down, which is what's expected now, then it means that your opportunity cost of holding gold declines, and therefore it becomes a more attractive asset.
Yeah, okay. This is very interesting to watch, and it's good times in South Africa at last.
Yeah.
Garth, what do the portfolios look like then?
All right, so our SA portfolio is the same as last week, no change. It's still up 4.2% for the year to date. Offshore, we're looking a little bit better finally. We are still minus 1% for the year to date, but that Amazon trade is working for us as things stand. We're up about $150, so obviously on the right side there and looking for that one to move up towards our target price.
And Garth, you've got a course coming up.
Yeah, on the 3rd of August, I'm doing a course in Johannesburg. So anyone that's interested in emailing me to go on that course or to attend, please drop me an email, garth@traderscorner.co.za, and I'll send you all the information.
Okay, we have to leave it there. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.